is a hedged equity fund. And what they mean by that is lots of little details, but basically it's equity index beta, passive equity index beta with a put spread collar overlay, right? So a put spread collar is a popular type of hedge, or anyway, type of option overlay for an equity portfolio where, let's say I own some equities, I might sell a call, collect some premium for that, and use that premium to go buy a put spread that gives me some protection against the market falling. That option structure together is going to have some short exposure to the market. So that's going to lower the overall beta of my equity portfolio from 1 to, depends on what it was, maybe 60 or maybe 50, depends on the strikes and so forth initially when I set up that hedge. And then in this case, we're just going to hold that put spread collar to expiration. We're going to enter into a new one, and it's going to alter the shape of my or of their equity risk return distribution, right? They're going to have capped upside. If the equity market rallies a ton, they're going to give up some of that upside because they're short the call. If the equity market sells off enough, they'll benefit at least to some extent from that put spread. And really, the reason why anybody cares about this is just because the fund has been well marketed and has been popular and is now really, really big, right? So it's I think $18 billion or so notional fund. And like a lot of these overlay style products, the end user here is typically high net worth individuals, ordinary individuals, RIAs. The simplicity is a focus of these kind of products. They're not trying to do really complicated stuff and have lots of positions, right? They just want to be able to explain it to you really easily. And so there, at any one time, there is just this equity exposure and this big put spread collar, and it's a very, very large position in terms of the size of the options in that put spread collar. And then once a quarter, that has to be rolled. And the size of that transaction to roll that put spread collar, from an options market perspective, is extremely large. And what happens when that trade is rolled really depends, and what kind of market impact it has really depends on what the path of the market has been, right? So let's take the example of this last week. The upside call strike, I think, was 44.30 on the structure that was in that fund. The S&P was below 44.30 coming into expiration. And so that means but not sufficiently far below, I think, the put strikes. I forget exactly what the put strikes were, but they were a ways down, right? So the whole structure is just out of the money and worthless. And so in the roll of this trade, JP Morgan is going to have to go to their brokers and say, okay, we want to quote a new structure. And this new structure, by the way, it's like a 50 delta or a 60 delta collar. So it's a sale of $11 billion of market exposure to go and do that, right? And that's a lot of equity exposure. It's not necessarily a lot of equity exposure to enter into over the course of a month or over the course of a week or something, but it's a whole lot of equity exposure to enter into just on a trade where you call up your brokers and you say, hi, I'd like to buy $11 or sell $11 million, $1 billion of stock, right? And that's why the trade gets exciting, right? And so then you get all the issues around, okay, when are they going to quote this? How big, when's it going to come? When's that delta going to hit the market? And everybody's speculating about it and so forth. Anyway, long story short, huge lumpy transactions occurring that have big impacts on exposure sold in the market.